Most traders fail not because they lack information, but because they have too much of it and they trust all of it equally. The market does not care about your strategy. It does not care about your discipline. It does not care that you studied for 6 months before placing your first trade. The market is a machine that transfers money from impatient people to patient people. And the cruel irony is that trying harder makes most traders more impatient, not less. Here is what nobody tells you at the start. The very behaviors that make people successful in every other area of life are the exact behaviors that destroy trading accounts. Working harder, reacting faster, staying informed, trusting your gut, doubling down after a setback. These are virtues everywhere else. In trading, they are landmines. This is the paradox. And until you understand it at a cellular level, you will keep losing money while doing everything you believe is right. Let me show you the first layer of the paradox. A surgeon who works more hours saves more lives. A lawyer who studies more cases wins more arguments. A salesperson who makes more calls closes more deals. Effort scales with output in almost every profession on earth. Then there is trading. A trader who makes more trades, in most cases, loses more money. Not because trading more means you are doing it wrong in the conventional sense, but because every additional trade you place is another opportunity for your brain to override your system. The more you act, the more you intervene. The more you intervene, the more emotion enters the equation. And the more emotion enters the equation, the more your results drift away from what your actual edge, if you have one, would produce. Research published by Brad Barber and Terrance Odean, two of the most cited behavioral finance researchers in the world, tracked 66,000 households trading through a discount brokerage over a 7-year period. Their conclusion was blunt: the more individuals traded, the worse their returns. The top 20% of traders by activity underperformed the market by more than 7 percentage points per year. The bottom 20% by activity, meaning the people who barely touched their portfolios, outperformed by 2 percentage points. They titled the paper, "Trading is Hazardous to Your Wealth." That title was not accidental. Now here is where the paradox deepens. When you show most traders this data, their immediate response is, okay, so I will be more selective. I will only trade when I see a perfect setup. And that sounds rational, but it is actually where the second layer of the paradox lives. Because when you decide to be more selective, you do not trade less. You obsess more. You watch the charts more closely, waiting for the perfect moment. You check your positions more frequently. You read more news. You join more forums. You consume more analysis. And all of that information flow does something specific to your brain. It manufactures conviction. There is a term in psychology called the illusion of explanatory depth. It describes the human tendency to believe you understand something far more deeply than you actually do. Studies by Leonid Rosenblatt and Frank Keel at Yale demonstrated this with everyday objects. Ask someone to rate how well they understand how a toilet works, then ask them to actually explain the mechanism step by step, and watch their confidence collapse in real time. Trading does the same thing at 10 times the speed. Every additional data point you consume about a stock, a currency pair, or a commodity makes you feel more informed. But feeling informed and being right are two completely different things. The market is not a test where more studying guarantees a better score. It is a complex adaptive system where the information available to you has already been processed by millions of other participants before it reached your screen. By the time you read the headline, the trade is over. This brings us to a concept that professional traders and systematic funds call the information trap. And it is worth spending time here because it explains why so many intelligent people blow up their accounts. Intelligence, as it turns out, is a liability in discretionary trading if it is not paired with a very specific kind of structural discipline. Here is why. Intelligent people are better at building narratives. They are better at finding reasons that justify a position they already want to take. In cognitive psychology, this is called motivated reasoning, and it is operating in your trading decisions whether you know it or not. You do not decide to buy a stock and then find reasons to buy it. You think you are evaluating the stock, but your brain has already formed a preliminary lean, usually based on nothing more than the price direction you have been watching for the last few minutes. Then every piece of information you subsequently absorb gets filtered through that preliminary lean. Confirming information gets amplified. Contradicting information gets minimized or rationalized away. Nobel laureate Daniel Kahneman documented this process across decades of research. He called the two systems of thinking that operate in the human brain System 1 and System 2. System 1 is fast, emotional, and automatic. System 2 is slow, deliberate, and effortful. When you are trading, particularly when a position is moving against you and you are trying to decide whether to hold or cut it, System 1 is in control. You experience the feeling of thinking clearly, but you are not thinking clearly. You are rationalizing. And here is the truly uncomfortable part. You cannot opt out of this. You cannot decide to only use System 2. The brain does not work that way. System 1 will always operate faster than conscious deliberation, and by the time you have consciously processed a situation, System 1 has already influenced the direction your reasoning will take. The only protection against this is to make your decisions before the emotion exists. This is what rules-based systems and predefined criteria do. They move decision-making to a moment when your account is not at stake, when no position is open, when the pain of loss is theoretical rather than present. But even rules-based trading contains a paradox, and this one is subtle enough that even experienced systematic traders fall into it. When you build a trading system and backtest it, you are looking at historical data and finding patterns that would have worked. The problem is a phenomenon called overfitting, and it is the reason that most backtested strategies perform worse in live trading than on paper. Overfitting means your system has learned the specific noise of the historical data set rather than the underlying signal. It is the equivalent of memorizing every question on one specific practice exam rather than learning the subject. You will ace that practice exam, but when the real test comes with different questions, you will fail. Here is why this matters beyond just system design. The same cognitive process that causes overfitting in code causes overfitting in human pattern recognition. When you watch charts long enough, your brain starts seeing patterns everywhere. It is not lying to you. The patterns are real in the historical data, but the brain, just like an overfitted algorithm, cannot distinguish between patterns that reflect genuine market structure and patterns that are random noise that happen to repeat a few times. This is why traders who spend years studying technical analysis often do not perform better than those who study it for 6 months. Beyond a threshold, additional pattern study just adds more false signals to your mental model. Now let us talk about the loss aversion trap, because this is where most accounts go from struggling to terminal. Loss aversion is one of the most documented findings in behavioral economics. Kahneman and Amos Tversky established in their prospect theory research that the psychological pain of losing a certain amount of money is roughly twice as powerful as the pleasure of gaining the same amount. You feel a $1,000 loss about twice as intensely as you feel a $1,000 gain. This sounds like a simple fact about human psychology, but in trading, it manifests in a specific and devastating way. It reverses the correct behavior at exactly the wrong moment. Think about what rational risk management says you should do. When a trade is working, you should let it run. When a trade is failing, you should cut it quickly. This is not controversial. Every experienced trader, every trading book, every fund manager will tell you this. Cut your losses short and let your winners run. But loss aversion tells your brain the opposite. When a trade is working and showing a profit, your brain wants to take it right now. Lock in the gain before it disappears. The pleasure of realizing that gain is powerful and immediate. Leaving it open means risking losing what you already have. And when a trade is failing, your brain refuses to close it, because closing it means making the loss real. As long as the position is open, the loss is theoretical. You can tell yourself it will come back. You can average down. You can look for reasons the thesis is still intact. The trade becomes not a financial decision, but an identity decision. Closing the loser means admitting you were wrong, and the brain treats being wrong as a threat to self-image. So you systematically cut your winners early and hold your losers long. And you do it while believing you are exercising discipline and patience. This single behavioral pattern is responsible for more blown accounts than any other mistake in trading. And it is not a character flaw. It is not a lack of discipline. It is the hardwired operating system of the human brain running exactly as designed, just in an environment it was not designed for. Here is the piece of this that almost nobody discusses. The market is not just testing whether you are right or wrong. It is testing whether you can maintain correct behavior across a sample size large enough to matter. Even a strategy with a genuine positive expectancy will produce strings of consecutive losses, not because the strategy is broken, but because probability is not evenly distributed. Flip a coin that is biased 55% toward heads enough times, and you will still see stretches of 7 or 8 tails in a row. The coin has not changed. The bias has not changed. The sequence is just what probability looks like in the real world. Most traders encounter a losing streak and conclude that their system is broken. They change the system. Then the new system has a losing streak. They change it again. They are in a constant cycle of abandoning strategies before they have had the opportunity to express their edge, if one exists, over a statistically meaningful period. How long is statistically meaningful? The answer is uncomfortable. comfortable. For most strategies, you need a minimum of 200 to 300 trades before you can begin to draw conclusions about whether the edge is real or imagined. Most traders make far fewer trades than that before deciding something is or is not working. They are drawing conclusions from sample sizes that can prove nothing. This creates what behavioral economists call the strategy switching trap, and it compounds the original problem in a specific way. When you abandon a strategy during a losing streak, you typically do not abandon it at the beginning of the streak. You hold on for a while, give it one more chance, then make the change after the streak has already run most of its course. You switch to the new strategy just in time to miss the recovery of the old one. And the new strategy, you implement it during a period of psychological damage. You have just taken losses. Your confidence is low. Your risk tolerance is compressed. You trade the new strategy with smaller size or with hesitation, which means that even if it performs well, you capture less of the upside than you would have if you had implemented it from a neutral psychological state. The result, you take the full loss from the old strategy's bad period and only a fraction of the gain from the new strategy's good period. This cycle repeats, and with each iteration, your account shrinks and your psychological damage deepens. So what is the actual solution? Because a diagnosis without a prescription is just entertainment. The first step is accepting something that most people resist with their entire identity. Your intuition is not an asset in trading. It is a liability that needs to be managed. This does not mean you are not intelligent. It does not mean you do not understand markets. It means that the human brain, including your brain, has systematic predictable biases that manifest in specific ways under financial uncertainty. Accepting this is not defeat. It is the prerequisite for building a structure that protects you from yourself. The second step is defining your complete trading rules before a single position is open. Not generally, not in principle, precisely. What is the entry criterion? Not when it looks like it is breaking out, but a specific quantifiable condition. What is the stop loss? Not depending on the setup, but a defined number, a defined percentage, a defined level relative to structure. What is the target? When will you add to a position? When will you reduce one? All of this must exist as a written document that you consult, not as a mental framework that you interpret in real time. The third step is position sizing with non-negotiable rules. This is where most traders underestimate the damage that can be done in a single session. If you are risking 5% of your account on each trade, and you take 4 losing trades in a row, which is not unusual in any strategy, you have lost nearly 19% of your account. Recovering 19% requires a 23% gain. The math of drawdown is asymmetric and brutal. Most professional fund managers risk between 0.5% and 2% of capital per trade. There is a reason for that. The fourth step is a performance review process that separates process from outcome. This is perhaps the most advanced concept in this framework and the one most overlooked. A trade can be executed correctly and still lose money. A trade can be executed incorrectly and still make money. If you evaluate your performance based purely on whether a trade made or lost money, you are using outcome to judge process. And in an environment with this much noise, outcome is a terrible judge of process. What you need to review is whether you followed your rules. Did you enter on the defined criterion? Did you place the stop where the rules said? Did you manage the position according to the plan? If yes, then the trade was executed correctly, regardless of outcome. If no, then the trade was executed incorrectly, regardless of outcome. Over time, correct process with a genuine edge produces correct outcomes. But the sample size must be large enough for the signal to emerge above the noise. Now, here is a concept that is gaining serious traction in quantitative finance and is starting to filter into discretionary trading circles: the idea of asymmetric bet sizing based on regime detection. In simple terms, not all market environments are equally hospitable to a given strategy. A mean reversion strategy that works beautifully in a low volatility, ranging market will get destroyed in a trending, high volatility environment. A momentum strategy that prints money in trending conditions will bleed steadily in chop. Regime detection is the practice of identifying which environment you are in before sizing your bets. It does not require sophisticated algorithms. It can be as simple as monitoring the relationship between current volatility and historical average volatility, or tracking whether the dominant stocks in a sector are trending together or diverging. The key insight is this: when the regime is hostile to your strategy, the correct bet size is 0, not smaller. 0. Most traders reduce their size in difficult conditions, but keep trading. They earn smaller gains and take smaller losses, but they continue accumulating the psychological wear of losing trades. Regime detection gives you permission to simply simply not play when the conditions do not favor your approach. You sit out. You preserve capital. You preserve psychology. You wait for the conditions where your edge is most likely to manifest. This is profoundly uncomfortable for active traders because sitting on your hands feels like failing. The market is moving and you are watching. Every tick feels like a missed opportunity. But this is the paradox again. The traders who are most willing to sit out are typically the ones who perform best over multi-year periods. Let us address the technology trap, because this is increasingly relevant. There is a massive industry built around selling traders tools, platforms, indicators, scanners, and signals. The implicit promise is that better information and faster information delivery will improve your results. And for institutional players with genuine informational advantages, there is truth in this. For retail traders, the effect is often the opposite. More data feeds more activity. More activity introduces more opportunities for behavioral errors. The trader who runs a dozen indicators is not more informed than the trader who runs 3. They are more confused, and they are more likely to find a combination of indicators that happens to confirm whatever they already want to do. The most successful long-term traders, both those running systematic funds and those trading discretionarily, tend to operate with deliberately minimal complexity. They identify a small number of factors they believe have genuine predictive value, they build rules around those factors, and they ignore everything else with religious discipline. This is not because they cannot understand complex systems. It is because they understand something crucial. In trading, the signal-to-noise ratio degrades as complexity increases. Every additional variable you add to your decision framework gives your bias another door to walk through. Here is the final layer of the paradox, and it is the one that ties everything together. The market rewards behavior that feels unnatural. It rewards patience when everything in you screams to act. It rewards inaction when every instinct says you are missing something. It rewards taking small losses when your ego says to wait for the recovery. It rewards running a winner when your anxiety says to take profit and be safe. The traders who succeed long-term are not the ones who figured out how to suppress these feelings. They are the ones who built systems that make the correct behavior the path of least resistance. Instead of fighting their biology, they designed an environment where their biology is less relevant. This means predefined rules. It means automatic stop losses rather than mental ones. It means sizing positions small enough that no single trade feels catastrophic. It means reviewing performance on a weekly or monthly basis rather than trade by trade, so the noise of individual outcomes does not corrupt your evaluation of the process. It means, ultimately, treating trading not as a test of how smart you are or how well you can read the market, but as a test of whether you can execute a predefined process consistently over a long period of time. The irony is that the traders who approach it that way, the ones who accept that they cannot outsmart the market, who build rules to constrain themselves, who embrace the boredom of following a system without creative deviation, those traders end up with something far rarer and more valuable than a market insight. They end up with an account that is still funded 3 years from now. And that is where everything in trading actually begins. Not with a hot setup, not with a perfect entry, not with the right indicator or the right time frame or the right news source. It begins with the willingness to accept that you are not the exception to the rules of human psychology, that your brain, like every other brain, has predictable failure modes under financial pressure, and that building a structure around those failure modes is not a sign of weakness. It is the only rational response to the environment you are operating in. The market has been transferring money from overconfident, emotionally driven traders to patient, process-oriented ones for as long as markets have existed. The technology changes, the asset classes change, the players change, but the fundamental dynamic does not. You now understand the paradox. The question is whether you will build a trading practice that takes it seriously, or whether, like most traders, you will read this and believe that you are the exception. Most people believe they are the exception. The market is very good at correcting that belief.